Some of you might have heard the 90-10 investment strategy. So for those of you who haven't heard of this strategy, what is it exactly? So this strategy is suggested by Warren Buffett, you know, the guy that's kinda rich, kinda successful, I guess? I mean, who am I to judge? He's Warren Buffett. Warren Buffett! It's actually quite surprising that the amount of resources I find online about the 90-10 investment strategy by Warren Buffett is quite rare, and I actually don't see a lot of videos on YouTube about this topic. So what is this exactly? What is this strategy? Quite simply, this strategy suggests that you put 90% of your assets in the S&P 500 and 10% in short-term government bonds. That's it. See? Simple as that. No nonsense, no BS. I mean, should you follow this strategy word for word? I mean, it is suggested by Warren Buffett, arguably the best investor throughout history. In this video, I will provide the pros and cons to this strategy and share my personal opinion on if you should follow this strategy or not. Hey guys, it's Eric here. Before we begin, please remember to subscribe and smash the like button for the YouTube algorithm for more videos regarding investing. So, the 90-10 investment strategy. Simple enough, right? But is it too simple? Like, it doesn't take into account the investor's age, the investor's risk tolerance, as well as the investor's desire to invest in other type of assets. So let's discuss some pros and cons about this strategy and what I would change in this strategy to make it more suitable for everybody. Let's talk about the pros first. First of all, using the 90-10 strategy obviously reduces risk as opposed to investing 100% of your portfolio into the S&P 500. So for example, if the market crashes by say 40%, you can see that your portfolio won't be hurt as bad as if you invested 100% of your assets in the S&P 500. Now in this example, we're just going to assume that the bond price stays the same, even though we know that's usually not the case. Also, if the market does crash, because you put 10% of your portfolio in bonds, you can actually cash out a portion of your bonds and invest it into the S&P 500. This type of rebalancing allows you to allocate more shares of the S&P 500 before the market rebounces, which then gives you a greater profit when it does rebounce. Secondly, not only are bonds safer, but they also provide you with a steady stream of income. So putting 10% of your portfolio inside bonds will provide you with positive cash flow to then reinvest into your portfolio. And last but not least, the S&P 500 has an annualized return of about 10% throughout history, so putting 90% of your portfolio in the S&P 500 doesn't sound like a bad idea. And also, the S&P 500 is very diversified. So all that sounds very good, right? What are the cons? Well, first and foremost, this strategy does not account for your risk tolerance. Different people have different risk tolerances, and age is definitely a factor here. So with that concept, it really wouldn't make sense for your average middle class family to be putting 90% of their portfolio inside the S&P 500 as they near retirement. I mean, you technically could, but I wouldn't suggest it, because if you're near retirement and the market crashes by say 40%, your lifestyle will be negatively impacted greatly because of this market crash. However, if you're younger and the market does crash by say 40%, you can most likely wait out the recession by the time you retire. So this is why the younger you are, the more risky your portfolio should be, because by the time you retire, you have a lot of time left and you can most likely wait out multiple recessions. So while the 90-10 ratio strategy might work when you're 30, when you're 60 for example, it might be a little bit too risky for you. Another con is that while the S&P 500 is very diverse, it really limits you only to the US market, and you're really not getting the exposure of other markets as well. Perhaps you're interested in investing in some tech IPOs. Unfortunately, the S&P 500 doesn't really include those companies. Also, if you're interested in, right now there's a big hype on weed stocks for example, you're really not also getting those exposure as well. So finally, what would I change about the 90-10 investment strategy? Honestly, I would make it a little bit more flexible depending on your age. For example, I've made a chart over here showing the split which I would do depending on age. So for example, if you're 30, the 90-10 strategy works fine, but the percentage of riskier assets by the time you're 65 should be lower. Another thing that I would change is the risky part of the portfolio. I would suggest you to diversify your portfolio and invest in other stocks as well as other indexes. So for example, I would suggest perhaps a combination of Dow Jones, Nasdaq as well as S&P 500. I would also go ahead and invest in overseas investments as well to diversify your portfolio even more. So for me, I invested in BBJP, which is a Japanese index fund. Perhaps invest in some stocks that have a very good track record and has a very good growth potential in the future. If you're curious, in my previous video, I did suggest some great long-term investment stocks. Perhaps invest in some healthcare ETFs or tech ETFs that has a track record of beating the S&P 500. Although they are a little bit more risky. I guess what I'm trying to say is the 90-10 investment strategy should be followed as a guideline and not word for word. Because everybody's situation is different. Your age can play a factor, and even if it's not age, your personal risk tolerance, for example, will make a difference. That being said, you might totally disagree with me, and that's completely fine. I actually enjoy that. Comment down below and let me know what you think, and I'd love to have a discussion with you. What's important is do what works for you. Everybody is different. Do what makes you comfortable. That's the most important. Anyways, thank you all so much for watching this video. Do you agree with my suggestions? If you don't, comment down below. Also, please remember to subscribe and smash the like button for the YouTube algorithm for more videos regarding financial planning, financial investing, job search, as well as financial comedy. With that, thank you all and I'll see you next time.